What if the US government suddenly couldn't pay its bills? Imagine the ripple effects: skyrocketing interest rates, plummeting stock markets, and a potential global recession. The debt ceiling isn't just a political buzzword. It's a financial time bomb ticking beneath the surface of the global economy. In this video, we'll unravel the complexities of the US debt ceiling, explore its historical context, and delve into the catastrophic consequences of a potential default. With the national debt surpassing $36 trillion and political tensions high, understanding this issue is more crucial than ever. Before we dive in, make sure to like, share, and subscribe to our channel for more informative content. Understanding the debt ceiling. The debt ceiling is a legislative limit on the amount of national debt that the U.S. Treasury can incur. Established in 1917, it was designed to control government borrowing. When the ceiling is reached, the Treasury cannot issue more bonds, meaning it can't raise funds to pay existing obligations like Social Security, military salaries, or interest on the national debt. This doesn't authorize new spending, but allows the government to meet existing commitments. Over the years, the ceiling has been raised numerous times to prevent defaults, reflecting the ongoing debate between fiscal responsibility and economic necessity. The historical context of the debt ceiling. Since its inception, the debt ceiling has been a contentious issue. Initially, it provided flexibility during wartime financing. However, in recent decades, it has become a political tool, leading to several standoffs. Notably, in 2011, a deadlock led to the U.S. losing its AAA credit rating for the first time. These confrontations often result in temporary solutions, like suspensions or short-term increases, without addressing the underlying fiscal challenges. The repeated brinkmanship has raised concerns about the U.S.'s long-term financial stability and its reputation in global markets. What happens when the debt ceiling is reached? When the U.S. hits its debt ceiling, the Treasury Department employs extraordinary measures to manage cash flow and continue meeting the government's obligations temporarily. These measures can include suspending investments in certain government funds and reallocating funds to cover immediate needs. However, these are stopgap solutions that only buy time for Congress to act. If these measures are exhausted without an agreement to raise the ceiling, the government would default on its obligations, leading to severe economic consequences. Essential services could be disrupted, federal employees might go unpaid, and financial markets could experience significant turmoil. The uncertainty surrounding such a default could undermine confidence in the U.S. government's ability to manage its finances, potentially leading to increased borrowing costs and a negative impact on the global economy. Economic consequences of a U.S. default. A default by the U.S. government would have catastrophic effects on both the domestic and global economies. Interest rates would likely spike, increasing borrowing costs for consumers and businesses alike. Stock markets could plummet, eroding retirement savings and investments. The U.S. dollar's status as the world's reserve currency might be jeopardized, leading to reduced confidence in U.S. financial stability. Additionally, a default could trigger a recession, with rising unemployment and decreased consumer spending. The ripple effects would extend beyond U.S. borders, affecting global trade and financial markets. The mere threat of default can cause significant economic disruption, as seen in past debt ceiling crises. Therefore, maintaining the full faith and credit of the U.S. government is crucial for economic stability. Impact on global financial markets. The U.S. plays a central role in global finance, and a default would send shockwaves through international markets. Foreign investors holding U.S. debt might lose confidence, leading to capital flight and currency fluctuations. Global stock markets could experience volatility, and emerging economies might face increased borrowing costs. The interconnectedness of financial systems means that a U.S. default could precipitate a global financial crisis reminiscent of the 2008 downturn. Countries that rely on U.S. financial stability would be forced to reassess their economic strategies, potentially leading to a realignment of global financial power structures. The trust in U.S. Treasury securities as a safe investment would be undermined, affecting everything from pension funds to foreign exchange reserves. Political ramifications of debt ceiling crisis. Debt ceiling debates often reflect deeper political divisions within the U.S. government. Partisan standoffs can erode public trust in government institutions and hinder effective policymaking. Repeated crises may lead to voter fatigue and skepticism about elected officials' ability to manage the nation's finances. Moreover, the use of the debt ceiling as a political bargaining chip can undermine the country's fiscal credibility and strain relationships with international partners. The political brinkmanship associated with debt ceiling negotiations can also distract from other critical legislative priorities, leading to a less effective government overall. The perception of instability can have long-term implications for the country's political and economic standing on the world stage. The role of credit rating agencies. Credit rating agencies assess the risk of investing in a country's debt. In 2011, Standard & Poor's downgraded the U.S. credit rating from AAA to AA+, citing political brinkmanship over the debt ceiling. Such downgrades can increase borrowing costs and signal reduced confidence in a nation's fiscal management. A further downgrade due to a default could have long-lasting effects on the U.S. economy, including higher interest rates and decreased investment. Credit ratings influence investor decisions globally, and a downgrade can lead to a loss of investor confidence not just in government bonds, but also in corporate securities. Maintaining a high credit rating is thus essential for economic stability and growth. Potential solutions to avoid default. To prevent future crises, some propose eliminating the debt ceiling altogether, arguing it's an outdated mechanism that causes unnecessary risk. Others suggest reforms, such as automatic increases tied to budget resolutions or fiscal rules that enforce discipline without threatening default. Implementing long-term fiscal strategies, like entitlement reform and tax code adjustments, could also address the underlying causes of rising debt. However, these solutions require bipartisan cooperation and political will. Establishing a more predictable and less politically charged process for managing national debt could help stabilize financial markets and restore confidence in the government's fiscal management. The 2025 Debt Ceiling Outlook. As of April 2025, the U.S. faces another impending debt ceiling deadline. The Treasury has warned that without congressional action, the government could default as early as late May or early June. Political negotiations are ongoing, with debates over spending cuts and fiscal priorities. The outcome will significantly impact economic stability and investor confidence. Observers worldwide are closely monitoring the situation, hoping for a timely resolution to avert financial turmoil. The current political climate, marked by deep partisan divisions, adds complexity to the negotiations, making the path to a resolution uncertain. The decisions made in the coming weeks will have lasting implications for the U.S. economy and its role in the global financial system. How individuals can prepare. While individuals can't control government decisions, they can take steps to mitigate potential impacts. Diversifying investments, maintaining an emergency fund, and staying informed about economic developments are prudent measures. Consulting financial advisors and avoiding panic-driven decisions can help navigate market volatility. Understanding the implications of the debt ceiling and advocating for responsible fiscal policies can also contribute to broader economic stability. Staying engaged with the political process and holding elected officials accountable for fiscal decisions can empower citizens to influence outcomes. Personal financial resilience is key to weathering the uncertainties associated with debt ceiling crises. The U.S. debt ceiling isn't just a political issue. It's a critical factor influencing global economic stability. Understanding its implications helps us grasp the stakes involved in these high-stakes negotiations. As we've explored, a default could have dire consequences, but informed citizens can better navigate the uncertainties. Stay vigilant, stay informed, and engage in discussions about fiscal responsibility. If you found this video helpful and informative, please hit the like button, subscribe to our channel, and share your thoughts in the comment section below. Thank you.